Vetri Subramaniam joins us, Chief Investment Officer with UTI AMC. Vetri, good morning. Thank you for joining us. The party
Good morning, Nikunj.
continues.
Good to be here.
And I've been told that the new definition of party is that it continues till the sunrise if you are in India and if you are in Goa. So looks like the party which started 3 years ago will extend itself.
Well, bull markets have a way of continuing, but they also have a way of ending abruptly. So, you don't want to be the last one to leave the party.
What should one do? Because every time anybody's made a case that valuations are rich, there is fraud building up in small and mid cap stocks. Watch out, there is bubble and trouble coming because of the way our central banks have been following a loose monetary policy. Those concerns, in a sense, have not disturbed the market. These concerns existed 3 months ago, 6 months ago, 1 year ago. But markets perhaps have learned to live with it. So, what should one do in this kind of a market when you know concerns are there, but markets are ignoring them?
Good question, Nikunjan. I would actually say that you are asking a question about things which are unknown. You will never know when a market makes a bottom. You are never going to know when it makes a top. These things are known only post facto. So my suggestion to investors, and this is my experience over 25, 30 years, nobody can tell you exactly when, where, and how the market is going to inflect. The only thing under your control as an investor is your asset allocation, your financial goals, and your ability to manage your risk. What the market will do is outside your control, it's outside your knowledge, it is in the realm of unknown. So, I prefer not to now focus on this issue of what will the market do, but look at the valuations, manage your asset allocation, and manage your risk. Let the market do what it does. If somebody's shirt is whiter than yours and they are partying longer than you are, so be it. That may not be for you.
Okay. So let's talk about pockets where you think, irrespective of the market, you would say that, look, my experience and my understanding of market cycle tells me one should avoid them. Where are those excesses in the market where, irrespective of if somebody puts a gun to your head, also you'll say, I'll better die and take a bullet rather than buying these stocks.
I like the analogy, Nikunj. Well, honestly, when you look at the marketplace today, if you look at the large caps, let's say we use the Nifty 50 as a benchmark for valuations, it is rich. But this is one of the unusual times in my career where I'm actually seeing the small cap index. I'm not referring to one or two small caps. I'm referring to small cap 250 index actually trading at a premium to the large cap index. And nothing that we have experienced in the past, either in India or elsewhere, tells us that these small caps can hold a valuation premium. There are multiple reasons why small caps face pressures. One is because they are more susceptible to economic cycles. Access to capital tends to be more limited. Breadth and depth of management tends to be limited. And finally, their ability to manage changes in regulations, changes in cycles is again limited. For that reason, I would submit that this kind of premium to the large caps in the small caps is one of the most disconcerting things that I'm seeing, and that is one area that I would be very, very concerned about.
Hi, morning. I also wanted to take a minute to discuss the new fund launches, the two index funds. Can you just walk us through a little bit more about them?
Yeah, sure. So we've actually got two index funds which are currently open. One is the Nifty 200 Quality 30 Index. The premise of this index is that it only invests in companies screened out of the Nifty 200 based on quality. What is quality? It's essentially companies with high return on equity, low debt to equity, and finally, low variability of EPS. So it's not EPS growth, it's low variability year on year in terms of EPS change. So you could think of it as low EPS growth volatility. Now, this quality, and at the other end, you could think about value, tend to sort of rotate in terms of market cycles. And if you look at the last 4 years, it's actually been value which has been at the forefront in terms of not only outperforming the benchmark, but a significant outperformance relative to quality. And this is an inversion of what happened, in the 3 to 4 year period leading up to 2020, 2021. So in our opinion, the market is now quite well placed for style rotation to kick in again, because this has been the pattern over almost 20 years where we have data that every few years the market sort of rotates in terms of moving away from quality towards value and then back and forth again. So we think this is a great time to sort of be looking at quality, and it can pull out an alpha relative to the Nifty 200 and also relative to value, where many investors may be exposed quite significantly. So that's the logic behind the Nifty 200 Quality 30 Index. The other index fund that we've launched is actually a little bit of a contrarian bet at this point of time. I talked about the challenges and valuations. The banks in general, if I were to put it that way, actually are one of the few sectors where valuations are reasonably attractive. And at the same time, for banks, most importantly, fundamentals are very, very healthy. Balance sheets are very healthy. So this is one sector where we think it's actually calling out, in terms of its valuations and fundamentals. And we actually think this is a great contrarian bet at this point of time. Of course, there are multiple issues that banks are facing in terms of headwinds, but it's only when you have headwinds that you end up getting, attractive valuation opportunities. And this is the pattern that we've seen over time. Go back and think about which were the sectors which were ignored, unloved 3 to 4 years ago, and see how much they are loved today. And, we think banks are very well placed for a similar kind of rotation.
Vetri, I'd like to draw your attention to what's happening in the PSU space. And even though this is the most exciting space right now, this space has already started seeing price-wise and time-wise correction. I'm talking about the higher flyers, defense, railway, shipyard companies. Is the leadership in some of these cyclicals and PSUs over, or this is just a time-wise correction which ultimately will adjust?
So, Nikunj, that's a very hard question to answer, right? I mean, you never ask this question about, let's say, Tata Group companies or Birla Group companies or Reliance Group companies. And I think that's a big challenge when you look at the Nifty PSE. There is no doubt that it has done well over the last 3 to 4 years, but I would submit that's maybe also some bit of the value trade playing out. But from my point of view, I would rather look at it stock specific at this point of time. There are some PSUs which are dominant, which are leaders, which are, best in class in the industries in which they operate, but there are many which are not. And I don't think those are the kind of businesses we would want to be exposed to. So I would actually recommend that you need to be a lot more stock specific, just like you would be very stock specific when it came to the Tata Group or the Reliance or the Birla Group.
Vetri, one other moving part now would be interest rates. For the first time post-COVID, globally interest rates will come down. We know interest rates is the linchpin which can act and which can really change the way how valuations and demand would move. So are markets factoring in a rate decline both locally and globally, or that is something which could surprise us?
Actually, Nikunj, my sense is if it surprises, equity markets may have more to worry about. The fact of the matter is that the US economy is continuing to do quite well, 3% growth in the June quarter. Yes, there are signs of slowing, but I think the big thing to keep in mind, in my opinion, is that monetary policy in the US and also perhaps in Europe is not going back to the setting that we had between 2008 and 2020 or maybe 21, where the policy rates were set at zero and the challenge was how do we get inflation. I think we are returning to more normal monetary policy, and therefore we can't expect interest rates to give you those kind of violent swings as we've seen in the past. So I think this is a very normal monetary cycle. Maybe the US cuts about 100, 150 basis points over 12 to 18 months, but you'll have a positive, sloping yield curve. And remember, inflation is still above their target of 2%. So it will sort of crunch their ability to manage. So I think at this point of time, I don't think interest rates in that sense, are going to see very dramatic cuts, including in India, unlikely to see big cuts. And therefore, it's not really going to be a source of big support to equity markets. And remember, the equity markets, which have already become pricey, I think, expecting interest rates to give them a further leg up, very challenging. Having said that, we do know that emerging markets in general typically have tended to see a lot more capital flows in and out, depending on the trajectory of interest rates. So there could be flows into emerging markets, but India's premium to EMs is very, very rich. So I'm not sure we'll be a big beneficiary of that, but certainly it will be a supportive trend.
Vetri, in this entire rotation which is playing out in the markets, kind of money moving, or at least, the PSU pack stalling somewhat, and you are seeing IT, FMCG, Pharma, the bottom-up stories actually come to the fore. You also talked about your thoughts on banks as well. But does it seem like, and I'm going to purely pick up FMCG here because of the rural recovery hopes, does it seem like a sustainable move?
It's hard to say at the outset, right? I mean, it doesn't signal to you that it's going to be sustainable or not. But the other way to look at this, Aisha, is that, the valuations of all the sectors which typically used to trade at a big discount to the index have moved up very, very significantly. So to my mind, what's happening to some extent in both FMCG and IT is these sectors, which typically held a very large premium to the benchmark, have significantly eroded that premium. And actually, you've seen a lot more, I would say, cyclical businesses, which over time have tended to be cyclical, not just in terms of growth, but also in terms of their ROEs, have actually moved up very dramatically in terms of valuation. So I think it's a little bit of a valuation normalization trade, whereby, if you're going to start paying FMCG multiples to capital good stock, then why not just look at the FMCG stocks where they may be rich, but they're far more stable in terms of medium-term outcomes.
Vetri, I'd like to also throw in elements like where the global risk-off trade is moving, what is happening to the bond market. Why are we seeing what could be called as a very synchronized bull market? Gold is up, Bitcoin is up, bonds are rallying. Housewives are saying they are very happy because gold is going higher. We are going through that phase that whichever asset class you've invested in, by and large, you've done reasonably well in last 12 to 18 months. Everything does not go up historically in a synchronized manner, but right now it is. I mean, bond and equity and gold going up together, I'm trying to understand the puzzle.
Well, actually, bonds have not really done all that well, except for just the very, recent period. It's not really been a great return. It's been a great yield for those who are willing to buy into it, but the holding period return over the last 2 to 3 years have not been very good, particularly in a global context because of rates moving up so sharply. I think as far as gold is concerned, to my mind, the reasons over there are more structural. I think after what's happened in the Russia-Ukraine conflict, and as people have seen the risks of holding significant reserves in dollars, you are seeing a lot of central banks tilt towards increasing their holding of gold. So I think the gold is in a little bit of a structural sort of support, which is coming from central banks thinking through risks that they are taking from a geopolitical standpoint and how do they manage their sovereign assets much better. So I think that's a structural tailwind that's supporting gold. I'm not sure it's connected to the fact that equities have been very well supported. Also, I would point out, if you look at Europe, it's done okay, but the world's second largest economy, which is China, is actually in pretty bad shape, both in terms of its economy and its stock market. So it's not that much of a synchronized uptick in growth as maybe it was in 21 and 22. So I think the world's a pretty sort of divergent tracks at this point of time.
We really appreciate your time. So glad you could join us.
If you like this video, then like, share and subscribe to ET Now.